Investors looking past the latest gloomy jobless data, driving stocks higher in a choppy session Wednesday. Joining us now for a closer look at the markets is Nicole Webb. She's a financial advisor at Wealth Enhancement Group, and she joins me from New York City. Welcome, Nicole.
Well, thank you for having me.
Great to have you with us. Now, the S&P 500 continues to climb despite weakening economic data, the latest being 20 million Americans jobless as of April, and companies warning of no earnings visibility up ahead. So this big bounce back we've had since March 23rd, is this justified in your view?
It's a great question. You know, the thing that I wish we could create, I haven't heard anyone say this yet, but I'm ready for a stock indice that pulls out big tech. You know, the conversation that I have to have with my clients on a day-to-day basis is, let's remove those big five names from the conversation and start to really look at what has happened in the market. So I think a couple of things are going on here. One, the investor is signaling to us an element of, I feel in control. I think it's pretty easy to see that the consumer, very different from the 2008 financial crisis, didn't really understand. That felt like a rug that got pulled out from underneath them in a way where they said, now I don't trust the market. This time, it feels like the investor, and certainly my clients, are signaling, I'm choosing to be a prudent steward of my community. I'm going to remain home. I'm going to consume less. But when this is over, I'm going back to my daily life. And as a result of that, I do believe that the equity risk premium, that volatility we're seeing, is pricing in whether or not we think that's happening sooner versus later. And for all intents and purposes, as we watch things reopen, the markets are showing a little bit of green.
All right, so I see justification for that. Now let's go to another theme, the Russell 2000. It has been outperforming the S&P 500 over the past month, 21% versus 16%. Yet you're steering clients away from small caps. Why, Nicole?
Yeah, so a couple of reasons. First and foremost, those small ships, small companies, they feel the waves bigger than the big ships. And I learned that analogy from my mentor almost 2 decades ago now, and that one has really stuck with me. What's interesting is there's a time and a place to take some size bias in a portfolio. And when we're coming out of economic recessions, it's a great time to capture that wave or the resurgence in small cap. But right now, when you're anticipating that volatility will remain high, volatility is generally even more pronounced in small companies. Think of that small ship and big waves. So what we're saying is, we do believe that volatility is here to stay for some time. When volatility is high, it remains high for quite some time. And so for our clients, to keep them invested right now, it's important that we decrease volatility while keeping their equity exposure. That's more where the tactical play from the small cap lessening is coming from.
Why then, Nicole, are you in favor then of REITs? I mean, REITs often, they say, sport small cap characteristics, especially valuations.
Absolutely. It's really interesting if you've never taken the time to Google, do small caps trade like REITs? And the answer you'll find is that yes, historically they have. However, the name of REIT, real estate investment trusts, especially as they are publicly traded, have really changed. And it's fascinating. It feels counterintuitive because how can we have these jobless claims that you just brought up, but still be bullish on real estate? And it's simple. Real estate has changed. Did you know that actually one of the biggest holdings in most REITs now is the long-term land leases beneath cell phone towers? That actually makes its way into real estate portfolios, along with data storage, both cloud storage and personal storage, and then distribution and warehouse. So we are bullish on those valuations, and we also think that low interest rates will create a tailwind in that sector.
Even though, Nicole, a lot of these REITs also own a lot of malls, and certainly malls, if anything, have been mauled, malls and retail stores.
Yeah, I think it's like anything. You truly have to be careful of what's inside of the investment you're looking at. Some of the major indices, though, that track REITs, you'll find that section of what's often thought of as, you know, the big names in malls or strip mall centers, generally are only making up about 10% of those portfolios if you're looking at a skilled manager in that area who is taking on the risk associated with certain subsects of the market. So again, it's really important to work with someone or do the due diligence on your own to really understand what's inside of any portfolio.
Any particular names that you like among the REITs?
I'm not at liberty to do that. I would get my hand slapped by compliance. So sorry.
Okay, well, let's save that for another day. All right, don't want to get you in trouble. Thanks a lot, Nicole, for sharing your views and your thoughts. Our thanks to Nicole Webb of Wealth Enhancement Group. I'm Fred Katayama, and this is Reuters.